Today's webinar is about investing in apartment buildings with People's Capital Group. It's presented by myself, Seth Martinez. My business partner at times also presents it. Today it's going to be presented by myself. And before we get started, we have a disclaimer that our SEC attorneys make us put up, and it basically just indicates that we are not securities dealers or brokers, and everybody should do their own due diligence before making an investment. Talk to your accountant, make sure the numbers work for you, and everything is copacetic for you. Okay, let's get started. Who is People's Capital Group? Well, we're hosting the webinar. We are a real estate investment company. We have annual earnings of about $1 million a year the last few years. We've done 250 closings in the last 5 years, totaling $30 million, combination of residential and commercial real estate. In order to do all the deals we do, which is roughly 5 transactions a month, we need to analyze hundreds of deals a month. So we look at roughly 200 to 400 properties a month. That doesn't mean we go to every property. A lot of that is done online. We have to manage our time. If we went to every single property, we wouldn't be very efficient. So before we actually go to see a property, we've already done our due diligence. And then to find those properties, we attract them through mostly our marketing. We spend upwards of $12,000 a month on marketing to find these deals. We also get deals from our network, our relationships with attorneys, realtors, brokers, contractors, and other people in the real estate business. We also have a large network, over 2,500 members in our monthly meetup group, and over 10,000 buyers on our buyers list. And lastly, we bring a lot of other deals and opportunities to the table, such as investments, education, and more. So that's some information about who People's Capital Group is. Here are the 2 founders. My business partner on the left, Aaron Fragnito, with a background as a realtor. He started off as a realtor about 9 years ago. He quickly became the #1 realtor in his office in RE/MAX, and he started selling me some properties back in 2011 and 12. At that point, we realized that we worked well together. We had the same vision for what we wanted to do with real estate, so we started partnering all of our deals together, and we started People's Capital Group in 2013. My background is in healthcare. I used to work in New York City. I owned a medical billing and consulting business from 2005 to about 2009. I sold it in 2009, stayed on for about a year, and then I moved to New Jersey in 2011. Okay, so let's talk about the problem. Every business has to address problems. The bigger problem you solve as a business, the more successful you're going to be. One of the problems we've noticed and have identified and we're trying to solve is that most people are not satisfied with their investment returns. And this is not just real estate, this is overall returns. So let's take a look at some examples of some annual investment returns, also known as return on investment, ROI. Here are the 4 main ones that people invest in. Savings accounts. They produce an annual return of less than 0.1%, upwards of 2.5%, a little closer to 0.1% or 0.05% historically. CDs are between 1 and 3.25. CDs are certificates of deposit. Municipal bonds, a little bit better, a little harder to get, up to 4.9%. And then stocks, they can even be higher, but they're more risky, less predictable. As we saw last year, stocks were negative for most investors. In addition to the returns, we have to factor in, every investor has to factor in inflation. So inflation actually wipes out most investments. The historical rate since World War II, going back about 75 years, is 3.6% annually, inflation. So that means the purchasing power of $1 today will be less a year from now. It'll be roughly 96.4% 1 year from today, if we take the historical average. So if you're getting 1 or 3% a year on your return, you might think that's good, but when you factor in inflation, you're actually usually getting 0% or negative percent. So what holds back most people from making better investments? A lot of it is uncertainty. A lot of it is fear. We have uncertainty of how to find a good investment, uncertainty of an industry, a market, and then simply how to invest when you find a potential good investment. If you don't have the experience, how do you go ahead and buy it? How do you make the investment? And then fear of investing alone, fear of making a mistake, A lot of the school systems that we go through, whether it's high school or below or college and beyond, they don't really talk about investing. So a lot of people begin their careers and go through their careers and they don't quite have the knowledge on how to invest. And then time. If you're working 40, 50, 60, 70 hours a week in a career, how do you find time to actually manage your investment? And then there's others as well. Okay, let's talk about a solution. A company that offers a proven method of making better returns through real estate. And that's what we're going to talk about the rest of the webinar. So here are some proven methods. Real estate has a track record, actually, of creating more wealth for more people than any other industry throughout history. It's created more millionaires as well. It does happen to have been around the longest, but still, that's a good track record. At the same time, many people find it hard to break into real estate. And those that have, not all of them are successful. And why? Well, a lot of them don't have the time to actually make their investment successful. Or maybe they didn't know how to properly handle the investment. So it's not a guaranteed success. You gotta know what you're doing, or you gotta work with somebody who does know what they're doing. But as it says here, real estate can be attainable for busy individuals or non-real estate professionals if they partner with the right individual or company. So over the last 6 years, People's Capital Group, myself and Aaron, have worked with more than 30 individual investors who have invested more than $5.5 million in private capital to partner in real estate with People's Capital Group, Aaron and myself. And that list always grows. There was a period where we stopped taking money. Now we're actually looking for investors again as we grow our business. So let's look a little bit more at the investment side. All of our investors, since we started the company, have made a profit on their investments. 90% of them have reinvested. And in many cases, many people have reinvested more than twice. So People's Capital Group creates passive real estate opportunities for individuals. And we're going to talk more about passive because there's actually two types of investments. One is a passive and one is active. The most common one is usually active, particularly real estate. And an active investment is something where somebody invests their money and then they have to continually manage the investment. It could be daily, it could be weekly, it could be monthly, but it's a constant management. In real estate, that would entail collecting rents, dealing with contractors, paying expenses on the property, making sure it's maintained properly. Real estate can become a very time-intensive business. In fact, a lot of books and CDs and even webinars talk about how real estate is passive. All you have to do is buy a piece of property and the rents will come in every month and you don't have to do any work. Well, that's not really how it works. Most people who buy a piece of property, they spend a lot of time managing it and it becomes very stressful. And that's why we actually see a lot of worn out landlords who've owned real estate for 10, 20, 30, 40 years. It becomes very grueling, very draining. But there is a way to actually invest passively in real estate, whereby you're not actively investing. You're investing passively, which means you're investing your money, but you're not doing any work. You're not paying any expenses. You're not collecting any rent checks. You're not signing any leases. You're not dealing with any legal matters. You're simply investing money. You're owning a piece of property and you're earning wealth. You're gaining cash flow. You're gaining equity growth through the properties, increasing value over time, and you're taking advantage of the tax depreciations as well. But how do you do that? Well, in order to invest passively, you do need somebody in the investment who's doing all the work, and that's what People's Capital Group does. Let's take a look at the next slide here. So People's Capital Group only works with qualified investors. We do not work with everybody. Here are the three main qualifications with our investors. So somebody has to have funds. Minimum is $50,000. Must be accredited. We're going to talk a little bit about that later, but it's an SEC, Securities and Exchange Commission term, and we'll get into that a little later here. And then again, must be easy to work with. I've heard some horror stories about investors who want to invest passively, yet they don't know how to, and they end up getting involved and causing problems. So our investors are passive, and they know going in that they're not going to be doing any work, and they don't want to do any work. They just want to take advantage of the gains that real estate brings when invested properly. Okay, benefits. Let's talk about the benefits. Investors have their money backed by the tangibility of real estate and the expertise of People's Capital Group for a passive and better return on their money. Here are the three ways of how our investors make money. Let's talk about them. First one is cash flow. That's the rents after all the expenses are paid in the property. The remaining monies are the cash flow, and those get distributed between the investors and People's Capital Group, and that's actually paid out quarterly. Equity appreciation, that's the increasing value of the real estate over time. All real estate, particularly in the metropolitan areas, increases in value over time if the buildings are maintained. And the average increase is roughly 3 to 4%. Tax depreciation, that's the third way. And this is a way of writing off the depreciation of the building against your taxes. So we'll talk about that as well. But taken together, all three ways can add up to a very good return, and you can beat the market. You can beat what's currently out there with, as we saw earlier, savings accounts, CDs, municipal bonds, and even stocks. We can beat those if we do the right investments and structure it the right way and manage it the right way. So let's look at an example of an apartment building that People's Capital Group purchases with its partners. In this case, we have a purchase price of $1.5 million. Now, what happens here is we don't bring all the money from our investors and People's Capital Group. What we do is we get most of it at a low interest rate, because then we can share that interest rate with our investors. So People's Capital Group has great banking relationships. We get a mortgage, we guarantee the mortgage, and we qualify for the mortgage. So we bring the mortgage to the table. That's usually 70 or 75% of the investment. And then what we do is we offer the investment to the most qualified investors who are available to invest. And in this case, that's about 35%. The extra 5% there, which is, if you add it up, it's 105%. That extra 5% is for closing costs and at times construction escrow, if we want to spruce up the building. So in this case, the investors bring in $525,000. It could be one investor or it could be numerous investors with a minimum of $50,000 each. It depends on each investment. So let's take a look at the next slide here. Same example. Let's look at the first way that we generate money, which is, as we talked about, cash flow. So the building brings in, for example, $15,000 in monthly rents every month. So what happens first is we pay the expenses. And as you see here, we have heat and hot water, electric, water, sewer, insurance, taxes, maintenance, vacancy, and management. And that creates, after deducting those expenses, a net operating income. Now, the net operating income is the net up from the rents, except one thing, and that's the mortgage. So after deducting all the expenses, the only thing that's not deducted is the debt service, which is the mortgage. Once we deduct the mortgage amount, then we get the net after debt service. So in this case, it's $2,825. And then that's the actual cash flow. That amount gets divided between the investor or investors and People's Capital Group, depending on the structure of the deal. In this case, the investor had 55% of the deal. So the investor gets 55% of the net after debt service cash flow, which is $1,554 a month. Let's look at the second example. This is not cash flow, this is equity appreciation. Same building, purchase price was $1.5 million. The investors' funds were $525,000. Now, the way we calculate equity appreciation is basically applying the historical increase in equity for that region. In our case, it's the New York City metropolitan area in northern New Jersey. And the historical increase in equity year over year is about 4%. It's also cumulative. It's not 4% from the base numbers. So if we apply the 4%, first year, the value of the building goes from 1.5 to 1.56 million. Second year goes up another 4%, as you see here. And it keeps going up over 5 years cumulatively. So after 5 years, the actual value of the building is $1.8 million. Then what we do is we subtract out the original purchase price from the 5-year valuation. It creates a net of $324,978. There are other ways to calculate the equity, but for this example, we're going to go with this. This is the simplest way. Now that $324,978, again, just as we saw with the cash flow, that gets calculated through the equity split, which was 55% to the investor, 45% to People's Capital Group. The 55% comes out to $178,000 over 5 years, which is 34.1% 5-year return. Divided over 5 years, it comes out to 6.8% on their money, the investor, over 5 years. Let's look at the third example of how our investors make money, tax depreciation. Again, same example, $1.5 million purchase price. Now, for tax depreciation, our accountants come in and they actually do the actual calculations. But here's a snapshot of how they do it. They basically look up the tax assessed value in the municipal records, usually less than the purchase price. In this case, our example has it at $800,000. Then they go further and they look at how that $800,000 was calculated. And it always consists of two things: one, land, and two, building, or also known as improvements. And the land is usually always less. And the land is also not deductible. So what the accountants do, what our accountants do, and our investors take part in our accounting service. So they don't have to pay extra for it, but they can also get their own accountant. But what our accountant does is they calculate the non-land portion of the taxed value by dividing the land by the actual building. So it's 150,000 divided by 650,000. That gets a ratio. They apply that ratio to the purchase price, and then they divide that over 27.5 years, which is the government mandated appreciation length or schedule. Why is it 27.5 years? Well, no one might know the exact reason, but that's what it is for apartment buildings. If it's a non-apartment building, it's actually 39 years if it's like an office space, office building. But for apartment buildings, it's 27.5 years. And that's basically what the government says it takes for a building to fully depreciate in value or basically fall apart. So the accountants take the formula, they apply it to the purchase price, they divide it by 27.5 years, and that creates an annual taxable depreciation. In this case, it's $45,734. And as we did with the prior two income examples, we multiply that $45,735 by the equity split. So the investor takes 55% of that, which comes out to $25,153. Now, one more step is involved. The $25,153 is not fully depreciable, but that amount gets applied to the investor's individual tax return or K-1 return, and that amount gets reduced from their gross income. So if they earned $100,000 that year outside of this investment, and they're paying, for example, a 40% tax rate, which is a little high, but let's say paying a 40% tax rate, normally they would have 40% of $100,000 taxable. But in this case, since they have $25,000 roughly in taxable depreciation, tax-exempt depreciation, they can subtract the $25,000 from the $100,000 other income, and then they're only paying taxes on the difference, which is $75,000. So they're paying $75,000 at, for example, 40%. So it roughly comes out in this example of 40% of the $25,000 is savings. In this case, $10,061. Again, each example is different. Each person has a different tax rate. Our accountants produce this data on a quarterly basis, and our investors also have the opportunity to use their own accountant if they would like to do so. Okay, so those are the three methods of our investors making money. Here's a summary. Same investment. We had three ways of making money. The cash flow came out to $93,000 over 5 years. The equity appreciation came out to $178,000 over the same period, and the taxable depreciation was $50,300. Taken together, that's $322,268 on their original investment of $525,000. So the 5-year ROI was 59.4%, and the annualized return is 11.8%. So on this investment, the investor would be making a very good return, and if he compares that or she compares that investment to stocks or savings or CDs, municipal bonds, they're in all likelihood beating that investment by a factor of 2, 3, or even 4 or 5. And they're also well outpacing inflation. Here's a continued summary. As it says, after 5 years, the investor has two choices. They can ask for all their money back, all their gains, the $322,000 and their original principal, or they can remain in the investment for another 3 to 5 year period and do the whole thing all over again and continue the good returns. If they choose to leave the investment, People's Capital Group will buy them out and they will sell their shares of the LLC. Okay, let's look at another case study and some other returns. So here was a property that People's Capital Group purchased in 2014. It was a 25-unit garden-style apartment complex. It was acquired for $1.075 million. People's Capital Group brought in 4 partners for the deal and also a bank loan, which it guaranteed. The investors did not have to get the mortgage, and they did not have to guarantee the mortgage either. The property was purchased with some issues. It had low rents based on the market comparables. It also had some higher than necessary expenses. It had some old furnaces that were not efficient. It also had situations where tenants were not paying for their heat when they could have. So People's Capital Group repositioned the property over 30 months, and we forced asset appreciation. How did we do that? Well, forcing asset appreciation is increasing the financial net operating income of the property. And the way you do that is you increase rents over time as tenants' leases expire. You bring in new tenants with better leases, and you also decrease the expenses. And you do that by having the tenants, where possible, pay their own utilities. And that creates a stronger net operating income, which in turn creates a greater value for the property. So after doing that, we forced the asset appreciation to 24%. We sold the property for $1.35 million in 2017 for a significant profit, which our investors shared in. And their average returns were between 11.3 and 12.2, again, depending on their tax brackets for tax depreciation, but they all had a very good return. PCG investment criteria, here is a general snapshot of what we look for. Now, that example we just saw was in South Jersey. We no longer actually invest in South Jersey, constantly revising our investment criteria to make it more efficient. And when you're in South Jersey, that's a 2-hour drive in most cases. It's just not so easy to manage and maintain. So right now we're within 60 minutes of New York City. Our office is in Berkeley Heights, so we're actually 30 minutes outside of New York City. So we're kind of in the epicenter of our investments, usually a 30-minute radius. We invest in Class C plus B real estate. There are 4 classes, A, B, C, D. A is the top of the line, best locations, best quality real estate, best tenants, highest rents. B is the next level below, C is the next level below that, and D is the worst. So we no longer invest in low D class neighborhoods, and even C minus, we like to get out of that. So C plus B, those are blue collar, white collar jobs, and tenants in good areas. We also look to buy our properties from motivated sellers. We do a lot of marketing, as we talked about earlier, to attract landlords who may want to sell. And a lot of the properties we buy are older landlords who've owned properties for 20 or 30 years. We then negotiate a good price, something that works for the landlord, it works for us. We also want to capture immediate equity. We want to get a below market value price. Capture equity, which we share with our company, with our investors, on average 5 to 25% market value. We're going to look at one more example after this where we did capture about a 15% discount, and we were able to share that with our investors. Minimal repairs. We don't want buildings that need a ton of work. We're okay with a little bit of work if we can do a forced appreciation with that. If it's in total disrepair, it's a different story altogether, different type of investment. And again, the strong New York City market with a $5 million maximum purchase price. Okay, another case study here. This is a recent property we just bought in January. This is in the New York City metropolitan market. It's Passaic, New Jersey, about 30 minutes outside of Manhattan. This is a smaller building. It's 6 units. We negotiated. It was an older landlord. We negotiated a price at $450. It was appraised at over $525. People's Capital Group, just like we did in the other examples, we brought in the mortgage for 75%. In this case, the investors came in with 30%. It was actually one investor for the down payment, the closing costs, and some construction funds to do the forced appreciation, which we're planning. Here are the roles of the parties. As we saw before, this is a little more specific. The People's Capital Group found the property, negotiated the price with the homeowner or the landlord. We secured the bank financing. We guaranteed the mortgage. We're also prepared to invest additional capital if required. And then we're going to be doing all the work. It's going to be an active investment, of course, for People's Capital Group. We're going to reposition the property, increase the rents, decrease the expenses, improve the physical condition of the property over time, and that'll create a higher valuation in 5 years. The investor's role was simply to bring in the funds and take part in a passive investment. Now, this was an extremely good deal, so the split was 60-40. We had several investors who wanted to invest, and these are the terms that we came up with. and the investor is set to make a very good return. Okay, let's go through the numbers real quick. The appreciation gains are anticipated to be 6% annually. That's the 4% annualized market appreciation plus the forced equity gain, forced appreciation through the increasing of rents over the 5-year period and the decreasing of utilities. As it says here on Zillow, this town, Passaic, actually saw a 19.9% increase in property values this past year. However, they still have not reached their peak from 2009. So even though you see a high rate this past year and probably even this year, it averages out to a lower rate because some years, as we saw in 2009, they were negative rates. So historically, they average out to about 4% without forced equity gains. With forced equity gains, they can be higher. Here is the projected 5-year return on investment. We see the equity gain, we see the tax depreciation, and then the cash flow. Cash flow is quite conservative, but we like to be conservative. We like to under-promise, over-deliver. So this investor is anticipating a $94,000 return on their $155,000 investment over 5 years. That's a 61% total return over 5 years, a 12.2% annual return. Here are a few testimonials from some of our investors. As I mentioned, we have about 30 plus investors who've worked with us over the past 30 years. In this case, these 3 investors have invested numerous times. As we see with Tim Carey, it's been 5 investments, Leah Charleston, 3 investments, Frank, 4-time investment. Okay, so here's a recap of the benefits. Earn greater returns through real estate, beat the market, beat the savings, the municipal bonds, CDs, the stocks. You can beat those returns. You're also diversifying your wealth, not having all your eggs in one basket. Some people like to just keep their money in savings accounts, but it's not only bad when it comes to returns and bad with regard to inflation, but it's also not a diversification of wealth. Tangibility of real estate versus hedge against stocks. Real estate can be insured. It's tangible. You can drive by it. You can touch it. You can insure it. You can't insure a stock. It can disappear in value dramatically overnight, if not 100%. Real estate can't do that. Outperform inflation. We talked about that. Tax depreciation. We talked about that. It's one of the best benefits of investing in real estate, and it's one of the only investments that allows tax depreciation. And then, of course, the New York City metropolitan market. It is the largest market in the country. It's 20 million people. The next largest is LA, which is about 16 million people. So it's the largest by far. Okay, how to qualify? Well, as we spoke about earlier, PCG only works with qualified investors. There's 3 or 4 main categories here of how to qualify. There must be liquidity. The investor must have liquidity of $50,000 or more. Must be able to invest long-term, 3 to 5 years. Must be accredited. There are some exceptions, but what is an accredited investor? An accredited investor, as defined by the Securities and Exchange Commission, is somebody who earns $200,000 a year if single, $300,000 a year if married, or somebody who has a net worth of over $1 million, not including their primary residence. This is a definition that was originally created back in 1933. After the Great Depression, the SEC was created, and it's designed to manage investors' funds from the government standpoint. Whether they do a good job or not, we don't know, but we still have to be compliant. And then must be easy to work with. As I mentioned earlier, these are passive investments, and we're looking for investors who are not looking to actively manage their investment. So let's go to the last slide here. If you qualify and you're interested in investing, and you can do one of the following things. You can call us, email us, go to our website. We're actually updating our website, but you can still go there and click on invest, fill out the information. And again, we review all applications on a first come, first served basis. And that's the end of the webinar. So thank you very much for attending. I wish everybody a great day, and we look forward to hearing from you. Bye-bye.